Hello and welcome to the newsletter for October 18th. Today we're going to be looking at a I think, fairly significant shift in not only the paradigm of where cryptocurrency is going, but it's kind of the biggest sign of confidence that we've seen from the traditional markets. We're starting to see Bitcoin being placed on the balance sheet of publicly traded companies, and in hindsight, this was actually a fairly obvious development that we saw coming. And it's funny actually because a lot of people have been talking about when nation states get there and when retail push thing up, and to date, really cryptocurrency at large and Bitcoin has been a retail dominated focus. During the last cycle, we really saw derivatives start to come to market and an increasing focus from hedge funds. So, kind of institutional scale things, but more funds that were developed in response to the industry. What we're now seeing is traditional and already established companies starting to take a serious interest in Bitcoin and actually putting it into their treasuries as a inflation hedge and ultimately as an asset that they believe will retain its purchasing power over time and is well positioned in the current macro landscape. So really, this is just an absolutely huge development in terms of demand. And the big difference here is that you and I might go and buy $100,000 worth of Bitcoin, and sure, we'll take a few percentage points of a coin off the market. But what we're seeing with this is, hundreds, thousands, tens of thousands, in some cases, hundreds of thousands of coins being taken off the market over periods of time. So, a single buy order from one of these institutions just simply dwarfs anything that you and I could ever impose on the market. And I guess what's even more interesting about that is that where we are in the cycle, and we're talking about huge accumulation of coins very, very late in the distribution. We're up to 18 point something million coins. So, it's going to take another 100 years to get the final 3 million coins issued. So we're talking about, institutions trying to buy a very limited supply. So that's really what we're going to be talking about today. And we'll touch a little bit more on some of the kind of the second order impacts when it comes to privacy and regulations and things like that. Just what this actually means in the longer run. So let's kick into it. So really what this is about is maturing markets. We had a newsletter a few weeks back where we were talking about how the markets really have shown quite resilient. They've been quite resilient in terms of price action, the performance, even though there's a lot of fairly significant moves in the market, BitMEX and KuCoin getting hacked and all sorts of other things and price really didn't respond to it, which during a less mature market would have been a serious dumping. And, we're starting to see that maturation. And, we're seeing more attention from the macroeconomists, the real visions, and now have a whole section on crypto. Macro Voices podcast. I don't think you can listen to a single Macro Voices podcast, which in my opinion is kind of the premier financial podcast, at least in the macroeconomic sense. There's not a single one of those where Bitcoin doesn't show up at some point in the discussion. At the very least, they talk about digital currencies and the replacement of fiat currencies and things like that. We've seen deep liquidity in derivatives. I mean, some of these companies have purchased, hundreds of millions of dollars worth of Bitcoin, and we haven't seen movement in price, which is, that is the scale of liquidity, and that is ultimately Bitcoin's selling point. Is the moat of liquidity is significant, and we've seen derivatives really explode since 2018, and the volume now well and truly eclipses spot. The other thing we've got is the rise of stablecoins and soon to be the rise of central bank digital currencies. So we're seeing China start to roll out their digital currency, and I'm very confident that the US and the EU will not be far behind. And now we're seeing Bitcoin moving onto the balance sheets. Companies like MicroStrategy, Square, ETF type products like Grayscale, really consuming a very significant amount of supply. So this is starting to look like an institutional market. We're starting to get that early sign that things are moving in a very, very big direction. And once you get this train moving, it's it's kind of going to roll in one direction. It's very hard to stop this. We'll get into some what that means in the regulatory and the moat that Bitcoin is really building around it. So MicroStrategy is probably the biggest buyer that's hit the headlines of late. So they invested in two different lots. One was I think it was 250 million, and then it was a follow-up round. They invested over $450 million of their treasury fund. So they were a very cashed up business, and they invested that into Bitcoin. And the unique case about MicroStrategy is they have a fairly forward-thinking CEO, Michael Saylor, and we'll talk about him shortly. And what his basic argument was is, I need to protect. I'm a very cashed up business. I have a huge treasury balance, and I don't have very much debt. And if you have a company that has a lot of debt and a lot of cash reserves, if you have inflation, the inflation is not only debasing the treasury reserves, so you're losing purchasing power of your treasury, but it's also making your debt easier to pay off. So if you think about like a counterbalance, if your debt is getting easier to pay off at the same time as your cash reserves are losing value, it kind of nets out to be equal. In MicroStrategy's case, they had very little debt, almost no debt, and a huge amount of cash. So in that instance, you're only losing purchasing power, and your debt, you don't have a debt that's getting easier to pay off. So you're actually just losing. And the concept here is that investing in the scarcity asset of Bitcoin is ultimately what they're using to protect their purchasing power. And you can see on the right here, there's like, in the purple is MicroStrategy's stock price. And when you announce that you've put your treasury balance into Bitcoin and you suddenly have a 40% price rise since that time, especially relative to your competitors who are doing the same thing, that's going to start turning some eyes, right? People are going to start looking at that. Other CEOs and other boards of directors are going to see that, and they're going to start taking it seriously. So that's really what this is triggering. Is it's putting a publicly listed companies allocating a huge amount of money into Bitcoin specifically. And, this is a significant portion of their treasury. I think it's something like $500 million. So they've put the vast majority of it into Bitcoin. We then have Jack Dorsey's Square, which has invested $50 million into Bitcoin. And, we're seeing here that, even JP Morgan says that it's a strong vote of confidence. So, these are publicly traded companies. All of them are getting stock price bumps as a result of this thing. So, it is a vote of confidence. We know that Jack Dorsey has been a strong supporter. I mean, his Twitter bio is one word, Bitcoin. So, companies like Fidelity, who do a lot of these financial products and market making and things like that, and giving traditional investors access to different investment products, ultimately, they're all votes of confidence and putting Bitcoin into the mainstream. So we've obviously had a lot of these macroeconomists talking about it, but now we're seeing actionable information of companies actually stepping in and putting their money where their mouth is. And, these are significant and important developments. And ultimately, this is the start of the snowball rolling down the hill. And, ultimately, I think this is going to become an avalanche. And I think this is a huge part of why Bitcoin's market and pricing has been so resilient of late. Despite a lot of FUD news, I think there's not only a lot of buy support, but people are starting to get it. People are starting to understand, and they're starting to understand across not only retail, it's now moving to institutional and high net worth individuals. We'll talk about some of that shortly towards the end. And then you've got the beast like Grayscale. So, Grayscale has really got what is kind of the de facto ETF product. And you can see on the left-hand side here, this is their total inflows into their product. So it's basically an ETF of various different. They've got all the large cap coins, and Bitcoin obviously being the largest. I think Ethereum is the second largest. One thing to be a little bit aware of here is there is what's called an in-kind arbitrage trade. So, there's this tweet on the right-hand side. They're talking about quarterly inflows of $1 billion in Q3. One thing to be aware about with Grayscale is if, let's just say that their ETF product, I forget what it's called, GBTC, I think it is. If GBTC is trading at a 10% premium, what you can do is you can actually send Bitcoin institutions can send Bitcoin to the Grayscale GBTC fund, and you get credited with GBTC at a 1-to-1 ratio. So that means that if GBTC has a 10% premium and you send a Bitcoin into that fund, you are essentially locking in a 10% immediate profit. So some of these inflows will be a result of in-kind flows. So it's not necessarily Grayscale buying the coins off the market, although they are buying a substantial sum of coins off the market. That is happening. But you can't assume that 100% of these inflows are them purchasing off the market. Some people compare it to the amount of mining inflow. Saying Grayscale is consuming more than miners are producing. And in some instances that will be true, but there is also an in-kind arbitrage trade depending on the premium. I know that the Ethereum, because their Ethereum product, for whatever reason, I don't fully understand it. If Ethereum is trading at $370, then the GETH product should trade at $37. For some reason, they've adopted a 10-to-1 model, and I think that's just ultimately confused the market, which I would hope they actually change. Because it basically means that Ethereum needs to do a 10x for any investor in GETH to make any money. So there's going to be a huge in-kind inflow of Ethereum investment to Grayscale there. But nevertheless, this is an institutional product that gives not only retail investors but also institutions access to a regulated ETF style product, and they don't have to buy and custody and all that kind of stuff. So Grayscale does all of that. But you can see on the left here, despite all of that, this is starting to look like a hockey stick chart, right? Where you've got a very, very long tail where there's nothing going on since 2013, and now we're getting institutional inflows. And you can basically see through 2019 it was picking up, and then 2020, particularly March, that's an acceleration, right? The rate of change of that inflow is substantially higher. So this is something to be certainly watching, but shows that proof of concept is now moving into a production level asset. And, we're seeing here that we've, Fidelity, Vanguard, Schwab funds loading up on crypto mining stocks. Another company, Stone Ridge, they reveal 115 million Bitcoin investment. I mean, these have all happened in the last month. So it's that gradually and then all at once. And, this plot on the right-hand side here is a size plot just showing the size of Bitcoins that have been accumulated by a number of different public and some private funds. You can see MicroStrategy there with 38,250. Grayscale's there with almost 500,000 coins. So, we're starting to talk about serious size, and a lot of these different companies have kind of exposed these investments within the last month. And, that's going to build an institutional rush and, some kind of institutional FOMO, particularly as stock prices perform and CEOs and boards of directors bonuses are all tied to their stock prices. In an era where stock prices are, somewhat on the edge with macro uncertainty, this suddenly starts turning heads, and it is going to be a bit of a bum rush at some point. And I think when this, I think this is the train leaving the station. To be honest, I think this is a huge move, and these are all publicly traded companies, so it is a vote of confidence. And there's this site called bitcointreasuries.org, which is built by the CoinKite, or the guys who build open dimes and cold card wallets, which is basically tracking all the different companies, how much they've invested in today's terms, how many Bitcoin they hold, what the percentage of the total 21 million supply that is. And you can see here that in the last month, we've really seen obviously, Grayscale's been investing over some time, and, it's not exactly over the last month, but we're now talking about 3% of the 21 million supply is currently held by publicly traded companies. Some of these are private, but listed companies. These are all on various stock exchanges, Nasdaq, Canadian exchanges. These are publicly traded. London Stock Exchange. This is really where the world is going. It's moving to becoming that accepted asset to exist on a balance sheet of a trading company. And when you put this against the backdrop of where that supply is coming from, so just to talk through from top to bottom here, this is the Bitcoin supply. Total supply is in blue. What is called the free float supply is the amount of coins that are deemed to be actually circulating, or at least live and not lost. So I think this discounts coins older than 3 or 5 years. I need to look into the actual definition. So it kind of, you can see here that it's discounting coins from 2014, more or less, that probably are lost. It's an attempt to try and understand exactly how much of the supply is actually in circulation. So we're talking about 14.4 million coins that are deemed to be in circulation and not, completely lost. And then we've got the 1 year active supply. So sorry, these are the coins that are actually on the move and, you would call liquid at this point in time, not being held by hardcore hodlers. And, it's fluctuating somewhere between 10 million and 6.5 million. So when you think about the amount of, we're talking about 500,000 coins by Grayscale, 500,000 versus 6.6 million is a significant percentage. So even if we get a very small percentage of publicly traded companies trying to put 1% of their balance sheet on, we're going to see this supply get constrained really, really quickly. So, this is kind of the backdrop that we're talking about. And again, this is really justifying the thesis. And it is important to recognize that this is Bitcoin's ultimate trajectory, in my opinion. I think Bitcoin is heading down this path of becoming a public reserve asset. I think it's an exceptionally powerful narrative. I think we're seeing the momentum now that is almost unstoppable. This is the trade for what Bitcoin is all about. It is purely 21 million supply and way more people trying to buy it and huge sums of money moving into it because of all of the macroeconomic reasons. So, ultimately, this is the trade for Bitcoin. It's a fairly simple thesis. It's fairly easy to get people's head around it. And ultimately, I think that this is going to seriously compete with gold in this particular environment, because it's just that, the 10-to-1 leverage on a new financial system combined with the scarcity meme, it's just so powerful. And we're seeing that vote of confidence by institutions. And what's important is note this downtrend. So since, 2018, this would have been our bubble peak. We've basically seen coins. This means that the 1-year active supply is getting less and less and less. These are people accumulating and seriously holding. You can see that 2019 there was a dip. This would have been the capitulation in December, and now, but we're still seeing this continued downtrend. So this is important. There is less coins on supply, ready for actual sale, and this is the same downtrend that we've seen in the volume coming out of exchanges. So really, retail got in all of this. This is our territory. We're now seeing institutions saying to step in here. So, we do have the leg up in the upper hand here. And again, this is my core thesis as to why I think you should maintain a fairly strong allocation to Bitcoin, because ultimately, this is Lindy effect, and the risk to reward is the best it's ever been, in my opinion, because not necessarily because of the reward. I mean, it would have been great to get in at 6 cents, but the risk of it going to zero was substantially higher. If you think about us having, sure, there might be less upside if you had to go in at 6 cents versus 11,000, but the risk of it actually going to zero now and the risk of it not gaining widespread adoption is substantially lower. So I think that the risk to reward profile for Bitcoin right now is probably the best that it's ever been. Now, let's just talk about some of the second order effects of all of this. So, public companies investing in Bitcoin, it's just made it a lot harder for governments to outright ban it, because you're now basically taking, there are regular stockholders who now have exposure to Bitcoin indirectly. And by banning the, Bitcoin itself, you're now starting to make it very politically sensitive and almost impossible, in my opinion, at least in the US, to actually block, ban Bitcoin. It increases the perception of legitimacy here. The stock price then increases. The stock price going up draws attention from CEOs and other executives. You've got the macro economy that's driving that demand profile, and then the price performance, both of the stock and Bitcoin itself, will start to create FOMO. And you don't want to be the company that said that wrote off Bitcoin as an investable asset for years and years and years and years, whilst all of your peers and your other CEO cohorts are making investments. And then when your fund doesn't perform the same way that everyone else does, people will say, well, why didn't you allocate? Why didn't you see this? So no one wants to be left as the fund manager who was the naysayer when it actually proved to be right. And ultimately, this is building a moat around Bitcoin, specifically Bitcoin. Corporate treasuries, high net worth individuals getting involved, deep liquidity, network effects. I mean, ultimately, this, in my mind, is solidifying Bitcoin as number one for at least for the very, very foreseeable future. This is what a moat really looks like, and it's going to be extremely hard to impossible for any other asset to really compete with this. And ultimately, Bitcoin doesn't need features in order to achieve this moat. So that is something to be very aware of, is that Bitcoin is a very unique asset in this regard, and the risk to reward for it has just never been higher in my opinion. Now, there is a dark side to this whole equation. So the deeper that Bitcoin gets integrated into the financial stack, it does have a downside. And the ultimate outcome of this is a little bit more sinister. So because governments now are going to have a hard time banning it because of its, it has that remote, it's now on the balance sheets and the like. Ultimately, the strategy they're going to employ is going to be to KYC identify it. They're going to adversely tax it, and ultimately, it's a mission to control it. So you can't beat them, join them. Ultimately, they probably know that they can't stop Bitcoin as an asset and as a movement, but they are most definitely going to try and make it difficult for people to use. I think it's going to be very challenging to use it as a money. I think Bitcoin is now becoming digital gold. I think that is probably where it will remain. I think it will displace gold. So, again, as an investable asset, very much so. But I do suspect that we're going to see things like, you'll have to report your crypto wallets on your tax returns. I think that they're going to have, whenever you transact or move it, it's going to be considered a disposal, and you'll have taxes and things applied to it. So ultimately, I think they're going to control it via adverse KYC and tax. Ultimately, if my view is that I invest in Bitcoin for the fiat gains. I think that long term it's going to become an asset like a pristine collateral, and the idea is that you would basically never sell, and you'll be able to loan it out and basically live off the interest. That's kind of my thesis. So I plan to basically hold the Bitcoin until I can lend it out and make ROI just by being early in and having coins. I think that's probably the way that this is all going, that's fine. That is a totally reasonable and appropriate use case for it. I think that's where it's going to go. I think that's Raoul Pal's vision for it, is becoming a pristine collateral. And what it actually does is it opens up different buckets for different assets. So we'll get to that at the very end of this section, which is coming up. To talk about my mental model for the different buckets of crypto assets and how I'm considering them moving forward. But it's just important to be aware of the implications when it comes to privacy. So we're just going to quickly touch on privacy and what I think it means. And please be aware that this is a very complicated issue. I'm by no means all the way across privacy and regulations. It's a very challenging thing to understand. What I'm trying to do is just understand the mental model where I think the world is kind of heading, where governments are heading, where regulations are heading, and just some of the ideas surrounding the delicate balance between privacy, sovereignty, and investment and staying on the right side of the rule book. And again, be very aware none of this can be construed as advice, because I just don't know. This is kind of me just formulating the ideas and kind of assessing the world around me as it's coming out. So on the privacy and anti-money laundering side of things, there is a delicate balance between transactional privacy and AML regulation. So obviously the government wants to understand where coins are moving. They don't want people to be laundering money. They often like to ignore the fact that fiat currency has been laundering money for, since day one. But, ultimately this is part of the control mechanism. It's part of how they maintain that government control over money. And ultimately, it makes privacy hard, inconvenient, and it raises, in inverted commas, red flags with regulators. But in my opinion, privacy is a human right. People have every right to be able to, maintain control of their data and information and be able to spend their money without somebody stopping them. So, I think that the immutability side of things is very important, and the ability to trustlessly send money. But it is going to be subject to the regulations. And the more that Bitcoin gets entwined into the financial stack, the more probable and almost guaranteed it is to come under heavy KYC AML scrutiny. So, it comes back to actually a great saying by our fearless leader Doc, is that you can't trade the market that you want, only the one that's in front of you. And whilst we may all want it to be a perfectly private, perfectly sovereign, KYC-less world, that's not the world that we're going to be given. And if any of you listen to the podcast, the Swan Signal podcast with what's his name, Eric Townsend from Macro Voices, and Jan Pritzker, and that's a really good one because you get to hear Eric's perspective on things, and his view is that I would love Bitcoin to be the full libertarian money stack. The fact is, I don't think that's what's going to happen. He believes that we're going to see central bank currencies. They're going to be all controlling, and they're going to do everything they can to regulate Bitcoin out of existence. Not necessarily out of existence, but certainly out of the money use case. So, we have to be conscious about what the rules are, and we have to know how to manage our funds in that context. So, this is the market that's in front of us. It's not the one that we may want. We may be heading there longer term, but, as with everything, we often underestimate how long it takes to actually get things over the line and working in the right direction. So, forgive me, I forget which document it was, but I did read a recent document by one of these 3-4 letter agencies that was talking about guidance on crypto asset red flags, things that should be identified as some kind of AML, KYC, pushing the envelope, things that should raise exchange red flags. Things like coin joins, use of privacy coins, exchange behavior, someone sending a Bitcoin in, swapping it to Monero and then immediately withdrawing it, or vice versa, stuff like that. These kind of triggers that are supposed to flag up and say, hang on a second, you have to investigate that, KYC that person, blah, blah, blah. So, what it really means at the end of the day is that you need to be aware and you need to be actively managing privacy. You need to be actively managing how you deal with things like coin joins, how you behave before and after transactionally. Again, none of this is ideal. None of it is perfect. And I certainly don't have the answers for what the regulators will or won't flag. And again, it's that balance that you need to do your own kind of due diligence and understand what you can and can't do, what might get flagged. There's layers of like plausible deniability. There's lots of layers to this whole thing. But I think ultimately the important thing is to be aware that this is kind of the direction that the market is going to be going, most likely, and then how you actually deal with that. So the next slide, I'm going to talk through, some of these concepts. And, again, let me stress that I just don't know the answer in full. I don't think anyone really does, because, until you understand how the regulators actually work on the inside and I think initially they're going to start very strong-handed, and maybe it will wind back over time as people start to understand it more. But it's more likely that they're going to be more strong-handed than not. So if we look at things like a coin join, so I'll just talk about point 1 here. If you do a coin join, which is the whirlwind on the left there, my kind of mental model here is, if you've done a coin join, you want to put some kind of distance between your coin join and when you send it to an exchange. So what that means is, if you do a mix, you're going to end up with the mixed funds and the change that comes out of it, right? Now, you don't want to combine those two because that completely nullifies the mix. And what you want to do is put some distance. So, it could be that you send the coins to yourself a number of times. It could be that you split them up and recombine them. So you take your mixed funds. The change should never be the change that comes out. So when you mix it, you're going to get a common denomination. That's the mixed funds. And then you get whatever is left over. And some people go and then mix that change, and you keep it going. But if you combine the change with the mixed funds, you're going to end up with, you're basically recombining, and you put in 0.15 BTC into the mix. It mixes out into a 0.1 and a 0.05. If you then combine those, you end up with 0.15, and they can trivially say, well, that input became that output, right? So you don't want to mix them back together. So put the change to the side. Let's ignore that for now. The mixed funds, if you then send it to yourself, and then maybe you split it up into 2 UTXOs, then you recombine those UTXOs, and you just do a bunch of normal looking transactions. You put some transactional distance, and you can do it over various spend timings. So, you could do one today, you could do one in 2 weeks' time, you could do the next one in a month, you could split them in a month and a half from now, right? You're just putting some distance between them. You could do a DEX transaction. Who knows, DCR DEX comes out, you do a swap in, a swap out, you just actions, normal things that you can do. Because at any point along that chain, remember that Bitcoins only have a history. You can't see what's ahead of you, but if someone was to look at that transaction and then they look back at the previous transaction, they say, well, that was a coin join, then you can say, well, more than likely, coin join, single spend to an exchange, that means that you coin joined it. You could have done that for money laundering purposes, therefore we're going to red flag it. If you do a coin join and then it transacts 1, 2, 3, 5, 10, 15 times, goes through a whole form of different things, at some point in time, you can say, "Oh no, hang on! I bought that off an exchange. That was that was sent to me via a friend. That was a payment." There's all sorts of plausible deniability that separates the coin join from yourself. But again, you got to remember that if you combine UTXOs, the only way you can combine a UTXO or two different coins is if you control both the private keys. So by coin joining by sending a transaction that combines two UTXOs, that immediately says that you own both of those, and then the history of both of those funds can reasonably go back to the coin join. So again, there's a lot of complexity in all of what I just described. It's completely imperfect, and really it's not ideal in any way, shape, or form. So the easiest way to deal with this problem, so if you looked at everything I just said for point one, and you just your head is spinning and it just looks too complex and inconvenient and all the rest of it, you are perfectly normal. To be perfectly honest, that's kind of where I'm at the moment. I think that whole process I just described is just completely unnecessary, ridiculous, and it's just too hard. The user experience of that is just it's heinous. So what I do is I have two separate buckets. So that means that I'm actively manage. I have different wallets, and I consider the coins that I have coin joined and mixed. Obviously, because I was just experimenting, seeing how it all works, but now I'm conscious that those coins are technically tainted in a certain way because, they now have a history of being mixed. And what does that actually mean for privacy? I don't know. If I sent them straight to an exchange, I would be nervous that they wouldn't be able to be accepted. I will probably end up moving those through a DEX of some form, or selling them on BISC or something like that to try and separate those things. But it's important that I keep track of the coins that I have mixed and the coins that I have not mixed. So I use Wasabi Wallet, and you can label each transaction. And I have done that. I've labeled the ones that are coin joined. I've labeled the ones that are directly from an exchange. So I know which ones are KYC'd. I know which ones are not. I have different buckets for different, I have my privacy coins, which I maintain separately. I have my private Bitcoin UTXOs, and I have my KYC'd UTXOs. If it does come to the time where you have to start reporting wallet addresses, you need to be able to do that. And, there's going to be linkages to your past history and all this kind of stuff. So, ultimately the thing you want to do is just be honest and control. Just need to be aware and control your privacy and how you use these things as you go. So again, none of this is easy or straightforward or ideal in any way, shape, or form. But this is the market that's in front of us, and it's important just to be aware and deal with it within your own context. But number three, this is the bull case for decentralized finance, and that applies to not only the Ethereum stack, but things like DCR DEX, things like BISC. Things like Lightning Network. These are all decentralized financial infrastructure. And if your view is like mine, the assets that I'm buying today, I really have no intention of selling for the next 5 to 10 years. I'm really accumulating for a very, very long-term play because I believe that there's a pristine collateral trade in all of this where you can basically just live off the interest of these assets longer term. So, again, a lot of this is very complex, and you can always grab me in the chat room to at least just talk about these ideas. Again, I don't know everything in full, but we can certainly discuss and look at probabilities and what we think is the most sensible approach and outcome. So in terms of my mental model, how I'm thinking about this market, this is kind of my current structure. So from left to right, we've talked about Bitcoin as being that unique asset. It is definitely becoming institutionalized. It's the pristine collateral trade. I think Bitcoin is digital gold, nothing more, nothing less. I think that is where it's going to be. I don't think it's going to fulfill the role of peer-to-peer money. I think it is going to become digital gold, and that is it. I think it's going to become very institutionalized, very regulated, KYC'd. They're going to start KYCing miners. It's really not ideal, but I think that's where it's going to go. Ethereum is and I've put some of its competitors in there because they're all going to be doing the same thing. It's the financial sidechain. It is the path. I think that Bitcoin being ported onto Ethereum is only going to increase. It's building the application layer for using this technology. Again, completely devoid of all privacy. I think it's going to become a regulated, financialized stack. There's huge trade there, but it's going to be compliant. We're not going to see the privacy-preserving, separate peer-to-peer economy. It's going to be regulated out the wazoo. So both of in fact, the left three buckets that I'm talking about here, including the pseudo equities, I suspect, yes, they're going to be permissionless in terms of access to some extent, but they're all going to be regulated. We're going to see KYC come to all of this stuff, and a lot of the pipe dreams of libertarians are probably going to be consumed once you add central bank digital currencies to all of this and the rise of stablecoins. I just don't see this becoming a fully permissionless, free-for-all market. I think over time it's going to be regulated. On the pseudo equities, we've got, they're capital assets, they're DeFi tokens. You're going to get dividends from them. They're basically distributed businesses. So, they're going to get regulated, I would suspect. I think KYC will come to it. You can't stake unless you KYC, all that kind of stuff. So, again, this is my kind of projection forward. But this is kind of the direction I see it going. And there is a very special bucket on the right-hand side here, which I think has a very small collective of participants. This is actually the complete opposite and the answer to what the left-hand side is saying. I think the right-hand side is what people think Bitcoin is and where people want Bitcoin to be, but I don't think it ever will go there. And that is true peer-to-peer money. This is the truly decentralized money layer. It's the private, it's the sovereign, it's the non-compliant. This is the rebels. This is the pushback. This is the, this is the punks. This is the living outside the financial system. Monero and Decred, I think, absolutely epitomize this whole ethos, this mindset, this technology stack. Lightning Network, I think that's, another one of these layers. There'll be side chains and things that fit into it. Haven Protocol, which is basically Monero with an oracle that allows it to be swapped in and out of synthetic assets, which I do, and I'm overdue to do a coin report on. I might do that. What I'm waiting for is their web wallet to come back online so I can walk you through it, because at the moment I find their command line interface is not overly useful for explaining the protocol. So I kind of want to show you the wallet and how it all works, and I'm still waiting for that upgrade. But either way, the right-hand side, the cypherpunks, is very different to the left-hand side. And I think it's going to, that is a use case. Sure, it could be a smaller use case, but there is most definitely a use case for people being private, sovereign, and in control of their own money without KYC and without, the liquidity will suffer. There's no question. Decred liquidity is horrible. Monero's liquidity is only going to get worse. You can't even buy it in Australia anymore with AUD. It's not going to be ideal. The likes of Zcash deliberately want to be compliant. So I think Monero and Decred are the epitome of this ethos. The technology they built is that. And this is why things like DCR DEX is so important. It's why Monero Atomic Swaps is important. So they are a separate bucket, and I think you must consider the pros and cons. I think there's obviously a lot of advantage to that. To having that privacy and having that self-sovereignty. But one must be very aware that liquidity will probably not be great. Price performance will, it could struggle. There could be a lot of bad news. There could be a lot of bans. It's the kind of place where, don't buy into these assets unless you are willing to weather some pretty challenging economic and price performance. I think that's kind of that's the crux of it. So, privacy is hard, inconvenient, and will be pushed back and red flagged. And ultimately, these projects are epitomizing that. They're striving for a better world in a realistic sense. They actually want the world to be better. But to do that, you've got to break some rules. And that, I think, just keep your eyes focused on the fact that they're probably going to be difficult holds. I think there's a huge amount of value in them, but I do think they're going to be difficult holds. So again, it's about awareness. It's just being understanding of what I think is coming down the pipeline. This is the market that is in front of us. And just to close, what I'm going to be doing is, because there's a lot of podcasts out there in this market, I try to get across a fair few of them, and that goes from everything from macroeconomics to crypto. So what I'll do at the end of each one of these newsletters is just give you a recommendation on some of the pods that I think are most relevant to the current moment. So, if there's one thing that I think you should listen to in that week, that'll be it. In this instance, it's the What Bitcoin Did podcast, and there was a recent 2-part interview with Michael Saylor, the MicroStrategy CEO, and they discuss things like the problems with gold, which is very interesting, actually. With gold, ultimately, if you have the price go up, More miners are going to come online. They're going to produce more gold. Previously unfeasible, gold that used to be, unfeasible at $2,000 an ounce becomes feasible at $3,000, right? When price goes up, more and more gold deposits can become possible to actually mine. How MicroStrategy and he actually filtered down to Bitcoin. The fact that there's a lot of widespread acceptance amongst his peers, they chat with investors and discuss the case as to why they wanted to buy Bitcoin. And many of these institutions and high net worth individuals were saying, yeah, no, I get it. I hold Bitcoin. I get it. I already own it. I think it's a good idea. And he also discusses this notion of Bitcoin as digital gold and Ethereum as the financial infrastructure. So I think it's a worthwhile thing to see how a CEO who has recently invested $450 million in Bitcoin, what is his line of thinking? So, I think it's a well worth podcast to listen to just get that insight into where the institutions are at and where their minds are coming from. So, thanks for tuning in for that. That was probably a bit of a long one, but it's a complex market, and whilst it's a vote of confidence, it is a double-edged sword. There is a privacy and regulation and AML side to all of this, and we can't really have the world we want. That's really what the cypherpunk bucket is pushing for. But in all cases, I think there is a huge evolution to all of this, and the opportunity remains, and the risk to reward has never been better, in my opinion. Central bank digital currencies are only going to accelerate the use of cryptocurrencies and acceptance of digital currencies. So I don't think the momentum is slowing down. I think the ball is rolling down the hill, and ultimately an avalanche is coming. And the supply side dynamics really speak to that. So thanks for tuning in. Thanks for and you can always grab me in the chat room if you've got any questions or comments, and in particular around the privacy side. It's a non-trivial issue that is it's hard to deal with, and I don't have all the answers. But otherwise, have a great week, and I'll catch you in the chat room. Cheers.